Thank you all for joining us for this commercial aerospace edition of the Gabelli podcast series. This is Terry Pope from the institutional team, and joining me is Tony Bancroft, portfolio manager and research analyst for the commercial aerospace sector at GAMCO. For the next 15 minutes, we will discuss the current commercial aerospace landscape and where we see investment opportunities. Welcome, Tony.
Thanks for having me.
So let's begin with a background. What is your focus area at Gabelli, and what do you cover in terms of sectors?
Yes, I'm an analyst and associate portfolio manager at Gabelli Funds. I have been with the company a little over 12 years, and I cover aerospace and defense and environmental services.
So the aerospace and defense industry is very broad. Can you tell us some of the focus areas that you cover, and then just broadly, what other industry subsectors are components of this?
Yes, we define the aerospace and defense industry as consisting of commercial aviation, business jets, general aviation, and defense. The commercial aerospace industry as a whole is approximately $840 billion in size. Service is the largest with about $480 billion, and commercial airplane production is about $360 billion. On the defense side, the market is about $2 trillion globally, and about $750 billion of that is in the U.S.
So COVID continues. Consumers and business travelers started to regain momentum in terms of commercial plane travel, and they've really scaled back here in September of 2021. So what are your near and long-term outlooks for the commercial plane industry?
Yes, the overall industry is expected to produce about 43,500 planes over the next 20 years, with the global fleet reaching 49,000 planes compared to about 26,000 planes in the current fleet. Although COVID and its variants have had severe near and term impacts on the global commercial travel, as passengers, travel is expected to be down about 57% from pre-COVID travel, the longer term outlook for the industry remains relatively intact, with passenger traffic growing at about 4% annually through 2040. Domestic travel will lead the recovery, with long-haul travel returning to pre-pandemic levels by 2023 to 2024. China, Europe, North America, and other Asian Pacific countries will account for about 20% each of the new plane deliveries, and the other 20% going to emerging markets. The global freighter fleet is in 2040 will be about 70% larger than the pre-pandemic fleet due to sustained demand tied to expanding e-commerce.
So looking to the past, what is some of the history of the industry?
Sure. Over the last 20 years, Airbus and Boeing have expanded commercial aerospace with planes like the Airbus A320 and the Boeing 737. These are less efficient planes built with aluminum and use smaller diameter engines. In that time, world air travel grew at about 5% annually, outpacing GDP by about 200 basis points. This growth has led to more fuel-efficient planes built with over 50 to 60% carbon fiber and specialty alloys, like the Airbus A350 and the Boeing 787.
So following up on your point about growth, near-term dynamics, what are the industry players dealing with today?
Yes, in the near term, the industry is what I like to say dealing with the three Bs. That's Beijing, business travel, and borders. The first B is Beijing. The Chinese regulators are expected to recertify the 737 MAX by year end. Boeing currently has about 200 MAX aircraft on order to the Chinese airlines and about 1,000 orders to an unidentified customers, with a large share likely going to Chinese customers or a lessor to Chinese airlines. But more importantly, they are almost 40% of the expected future orders of the MAX. As we know, Boeing 737 MAX is the largest U.S. manufactured export product to China. And Boeing has stated in the past it expects China to purchase $1 trillion of aircraft over the next 20 years. This obviously is a work in progress with current pandemic fears, travel restrictions, trade talks, and China building its own single-aisle plane, the COMAC 919. The second B is what we call business travel, and that's been impacted by COVID and its variants, of course. Business travel is only about 12% of the passenger traffic, but could be up to 75% of the airline's profits. So it's an important piece. It's expected that corporate travel spending will not return to 2019 levels until the end of 22. Lastly, borders. This year, IATA, the airline trade organization, expects global travel to fall by 57% year over year, and is not expected demand levels to return to 2019 levels until 2024, a year later than originally expected.
So to summarize, do you see air travel being resilient over the long term?
Yeah, over the long term, air travel has shown to be resilient despite financial and geopolitical challenges. Air travel has recovered and grown after the 1970s oil shocks, the Gulf War, the Asian financial crisis, the Second Gulf War, SARS, and the global financial crisis. Obviously, compared to previous recoveries, COVID has spread much wider and has been more impactful than previous crises. And business travel, which has historically been tied to GDP, has seen weakened correlation as teleconferencing has made significant inroads to business business interaction.
So focusing on commercial travel, what's really driving the global growth?
Yeah, global commercial travel fundamentals that have driven air travel for the past 5 decades and doubled air traffic over the past 2 decades remain intact, and the industry is expected to recover. This is mainly driven by over 300 million people in China and India who are expected to enter the middle class over the next 10 years. We have seen that more consumer spending directly correlates to more air travel. Passenger growth is expected to grow from 4 billion passengers pre-COVID to 8 billion passengers over the next 20 years, while the number of passenger journeys is expected to double by then as well. Global revenue passenger kilometers, or RPKs, are expected to grow from 8.5 trillion to 18.6 trillion in that time frame. Airline market liberalization and deregulation continues to stimulate growth, while improvements in infrastructure and new airports has also allowed for increased capacity. Technology has improved air traffic control, routing, and gate optimization, allowing for longer operating hours at airports. The low-cost carrier model, which has reduced ticket prices, has increased growth in many markets and added new routes throughout the world.
So over the next 20 years, what do you think the global market looks like?
Yeah, over the next 20 years, the global fleet is expected to grow by about 25,000 planes to almost 50,000 in just 20 years. About 44,000 new planes will be needed for growth and replacement. But in the near term, the rate of retirements has doubled as more fuel-efficient planes offer 35 to 40% better operating costs, which has helped offset lower new growth with replacement demand. COVID has increased retirement rates even more due to so many jets getting parked for such long periods of time. Of those 44,000 new planes, the mass majority of the growth will be in single-aisle space aircraft, as most of the growth in Asia and India will be intra-country travel. Single aisle alone is expected to deliver 32,000 planes over the next 20 years, which is now bigger than the entire current fleet.
So we hear talk about production today. What does the backlog in production look like going forward?
For backlog, although we have seen some recent cancellations and deferrals from customers, there is still about 10 years of production at normalized rates, with Airbus still at 7,000 planes and Boeing at 5,000 planes in backlog. For production, Airbus is expected to increase production of the A320 to 45 per month by the fourth quarter of 21, and Boeing is expected to increase the MAX production rate to 31 per month by the first quarter of 2022. We expect overall production for the industry to return to growth beginning in 2022, with about 1,200 planes being produced globally versus about 850 in 2021 in the commercial space.
So defense spending is obviously very important for the growth of this sector. Can you tell us a little bit about what you see?
Yeah, for sure. Global defense spending has increased 20% in the last 10 years to about $2 trillion annually, and the U.S. having the lion's share with about $750 billion. China has over doubled its defense spending in the last decade and could be on pace to eventually match the U.S., though this number is misleading as it takes into account spending on personnel and, if backed out, based on FX rates, would likely show much higher spending growth on procurement pari passu with the U.S. The U.S. defense budget has grown 23% or almost 4% annually over the last 6 years, driven by increased spending after sequestration in order to get back to what the DoD views as sufficient levels of readiness. The Pentagon estimates U.S. defense spending will need to grow by about 2% annually for the next 4 years in order to properly maintain current force levels and future programs. But increased deficits and spendings may impact future budgets. However, the historic evidence suggests that recessions do not necessarily lead to decreased funding for the Pentagon. Rather, budgets are generally stable and mostly impacted by post-war spending declines.
So, Tony, how does the current investment opportunity in your sector compare with others you've experienced in your career?
Yeah, I'd say, currently we're seeing very good opportunities in aerospace and defense as the market has sold off with lower passenger travel, obviously business travel, and border closings. But the outlook and for the long term remains relatively unchanged as secular and structural dynamics continue to drive demand through 2040. So I do see a lot of opportunity in the aerospace and defense sector.
So over the past year, there's been much talk of digital acceleration as a result of the pandemic, and businesses in your sector have obviously benefited. And can you give us an update on trends you see and how durable are they?
Yeah, I think there are actually quite a few trends in aerospace and defense. I think in general it leads technology. The first and foremost I think about is artificial intelligence, AI. It's going to be a large driver. It is a large driver and will continue to be a large driver, particularly in the autonomous space where unmanned vehicles will be doing a multitude of tasks as far as combat operations to logistics. I also see in the space sector, which is, for all intents and purposes, probably going to be the next battlefield, needing a lot of computing power and technology to operate in that environment. And thirdly, I'd say hypersonics. Hypersonics is sort of the next generation weapon. It's something that can do a lot of damage with a relatively low cost. I think there's going to be a lot of technology that's going to be needed there as far as guidance, programming, and just all the sort of technology that goes into that weapon system.
So, given everything we've talked about today, can you share with us some of your favorite stocks?
Yeah, I'd say favorite stocks. I continue to like Boeing. The company has 585 million shares, trades around $212 for $124 billion market cap and $55 billion of net debt. Boeing is aligned with all the fundamentals we've discussed in air travel recovering and global demand for over 43,000 new planes in the next 20 years. Boeing has a backlog of over 5,000 planes and is expected to ramp 737 production to 31 planes a month next year. I'd continue to buy the stock.
So broadly, how should investors think about this sector and investment opportunities?
Yeah, I guess I'd say in summary is that we're starting to see the shoots of commercial aerospace recovering, but still not returning to pre-pandemic levels for a couple of years. But in the long term, the thesis sort of remains intact. The secular and structural drivers that have grown the industry over the last 50 years essentially continue and will likely be the drivers going forward, particularly in the emerging markets. On the defense side, the industry is relatively stable. The current global and geopolitical environment doesn't seem to be settling down anytime soon, which we've seen recently in the news, and will likely, all things being equal, will continue to be a factor going forward for NATO and essentially all of our allies. So I think that is a good reason to allocate assets to the aerospace and defense industry. There's a lot of potential there.
Well, thank you, Tony, and thank you all for joining us for this commercial aerospace edition of the Gabelli podcast series.
Thanks.
The following are disclosures related to this podcast. Equity and fixed income investments are affected by market conditions. The intrinsic value of the securities in which our portfolios invest may never be recognized by the broader market. The opinions expressed are current as of September 17, but are subject to change. The information provided in this podcast does not produce information reasonably sufficient upon which to base an investment decision and should not be considered a recommendation to purchase or sell any particular security. Portfolio holdings are subject to change. The performance of any single portfolio holding is no indication of the performance of other portfolio holdings of any strategy or fund. Comments made on any individual company or stock is not an indication that it is currently held in a portfolio, nor is it an indication that it ever will be held in a portfolio.
In this episode, several companies were mentioned. We own less than 1% of the following: Airbus, ticker AIR.PA, Boeing, ticker BA, and the Commercial Aircraft Corporation of China.